A rack-rented property is one where the cash flow commences at market rent and conforms to a normal market rent review pattern. The valuation uses market information to assess the market value. In this video I am introducing the valuation of rack-rented property by implicit all-risks yield techniques and explicit DCF models. The all-risk yield is also a convenient measure for the analysis and valuation of rack-rented freehold property. Effectively, the all-risk yield states that such property investments sell for a certain multiplier of the rental income. Adjustments to the all-risk yield to reflect differences between comparable investments and the subject property are made. For example, if the lease is long or of a customary length of 15 years, then all-risk yield is reflecting the possible void on lease expiry. For a shorter lease, say 10 years or less, it is customary to allow for the void period explicitly. Care needs to be taken when selecting the all-risk yield for a shorter period. For example, it would be inappropriate to apply the same all-risk yield to the valuation of a property with a 9-year unexpired lease reflecting an explicit void as against that applied to the valuation of a similar property with an 11-year unexpired lease and no explicit void. Please like, share and subscribe for more videos and write your comments or questions. Implicit valuation or capitalization. The all-risk yield implies growth relative to the target rate. If an investor is requiring a target rate above the initial yield, then there must be a growth expectation equivalent to the difference. If an investor accepts an initial return of 8%, but requires a target rate of 10.7%, then the income must grow annually by the equivalent of 2.7% over the year for the 10.7% return to be reached. The simple annual growth calculation of deducting the initial yield from the required overall yield is only true where incomes can legally change annually. With property, the rent review pattern means that not only does an investor need a certain level of growth each year, as above, but the investor also needs additional growth to compensate for every year that the income is fixed. Using the same all-risk yield and target rate, 8% and 10.7%, with 5-year rent reviews, this implies linear growth at 3.2%. If growth turns out to be lower than this linear average figure, then the investor has paid too much for the property. If growth turns out to be above 3.2%, then the investor will achieve an overall return of above 10.7%. In the analysis, the expected growth is reflected in the income flow. However, in practice, there may be accompanying changes in the exit yield, which may lead to an increase or decrease in the capital value at resale. Explicit valuation. The explicit discounted cash flow method discounts the projected rental income flow at the investor's target rate. The cash flow is increased explicitly by applying the growth figure of 3.2%. This model uses annual in arrears assumptions and assumes a sale at end of lease at an exit yield equivalent to today's all-risk yield. In the discounted cash flow example shown on the screen, the income column is explicitly grown at the implied growth rate of 3.2%, and then each 5-year cash flow is discounted at the equated yield of 10.7%. At the sale in year 11, the capital value is calculated by assuming it will be sold at an exit yield of 8%. In the case of a rack-rented freehold, the DCF method produces the same value as the implicit method if the DCF inputs are derived from the all-risks yield. As a valuation method, the advantage of the discounted cash flow method is that it makes the assumptions underpinning the explicit valuation. If you have found this video useful, please like, share and subscribe for more videos and write your comments or questions.